of all, before we sit, I want to thank again your Reserve Bank here at Philadelphia for having us over yesterday and today, and to have everybody in the room as well. It's been a very extremely interesting set of interventions yesterday, and I think a lot of the discussion was also around productivity, and we spoke around inflation in the context of the future and how central banks can manage and work on their toolkit to respond to the future crises and the overlapping emergencies. And actually, you've done quite a lot of work in this area. So you are the Emirates economist here at the Federal Reserve Bank of Philadelphia. And a lot of your work is around looking at GDP. Is it the correct measure? Should we be looking at how we use other measurements? And actually, I think you were saying earlier that it was starting in tech, but you've moved to looking at actually the economic cost of the climate crisis. So today we're going to start with looking at that, but also we will delve into the productivity and tech questions, which is excellent because we then go into managing central bank balance sheets and the quantitative tightening questions with David, and then we go back to the central bank digital assets and the future of money, so those AI questions before we close out. So you kind of have a nice morning where we can really get our brains thinking and as all in the right framework. So please, Len, my first question to you is, how are you thinking about the economic cost of the climate disasters, and how do you think that we, as in the financial community, should be framing these discussions?
Okay, so I got into climate work because we live in a time in which externalities are dominating the economy. Externalities are side effects of economic activity from the point of view of economic measurement. So when we measure Google, for example, we think from a GDP perspective, we ask the question, how do investors and workers get paid? What does Google get paid to do? Well, Google gets paid to advertise. The fact that it's also a search engine, an externality from the perspective of GDP. Similarly, when we pollute the environment, that's an externality. It's an unintended consequence of economic activity, but no one is getting paid for it. Might get fined for it, but that's a separate issue. So a mining company or that also polluting may some of their profits are in some sense socially being dissipated by the pollution. One of the questions we need to ask about productivity is, what are we measuring in an era in which externalities have been crucial to economic activity? Climate change, or whether about free goods or open source software. So in terms of measuring climate change externalities, one way to go about that is to measure the damage that we're doing to the natural environment, to our natural resources, and whether that's sustainable. Another way, a supplementary way of doing that is to ask the question, what harms climate change actually causing? So we've seen an increase in floods, wildfires, hurricanes, so forth, and all their damages. And but by and large, national accountants track GDP have not put this into their data. So, for example, well, let me start again. In the United States, though, we've had an organization, the National Oceanic and Atmospheric Administration, the weather guys, who have actually been tracking climate disasters since the 1980s. Terrific economist named Adam Smith has been leading this effort. And he's one of the unsung heroes of climate work. And so what they do is they collect billion-dollar weather and climate disasters. So basically what these are is looking back, what events caused over $1 billion in damages, thinking about this in today's dollars, deflating using the CPI. And then they've made a long time series out of those events, summed up each year. And if you look back at the 1980s, you see about $21 billion a year in climate disasters in today's. In 2013 to 2022, the last decade, the $111 billion. Now, 1980 was the last time we were more or less temperature-wise on track with the previous 100 years. So we think, and there's some reason to believe that most of this is the impact of climate change. And it has a very strong trend. It's growing 5.5% a year. That means it doubles every 13 years. So in 2002, we had $175 billion in climate disasters, and that was right on track with the trend. So in 2034, in another dozen years, we expect something like $350 billion in disasters. Put another way, in the last decade, we had over $1 trillion in disasters, and around $2 trillion. So are those big numbers? Small numbers? Well, one way to think about it is that the Inflation Reduction Act is going to have us spend $370 billion over a 10-year period, compared to a probable loss of $1 billion. It's not clear that we've quite gotten serious yet about our problems.
That was actually going to be my follow-up question, is if these are the numbers that we're looking at facing a climate disaster, do you think that the US or the world is ready for it? And how do you think the financial sector and the community is responding? And do you think that that is adequate enough that you're talking about the Inflation Reduction Act being from the UK? I will not call it by its acronym, but the Inflation Reduction Act, I think is one way that has been kind of outwardly tackled, but is it enough? And do you think that there is enough focus in the global community to be tackling this huge? Yeah.
Well, climate change is a very, very tough problem. And one of the ways to think about this is that in terms of the technology of battling climate change, we are far behind China. China has been the leader in electrification. It's about to become the leader in regenerative electrification. It's about to become the leader in transportation. And we're losing out in one of the largest markets of the future. Now, I should have mentioned before I started talking that I'm emeritus at the Philadelphia Fed, so clearly I do not speak for the Federal Reserve Bank of Philadelphia or the Federal Reserve System. But you know, we need to be funding investments in crucial areas. And now, exactly how to do that is hard to say, but it's particularly difficult given our budget problems. I think yes, my sense is that, you know, given our political problems, we're kind of not doing too bad, but it's not good enough.
I think ONFIF does a lot of work in Europe as well, and the conversations that we've been having around the Next Gen EU and also the funding, so 40% of the Next Gen EU being put towards green and the green transition. But on the flip side of that, there not being the projects that on the ground that can kind of take that funding. So they know that there's funding there, but there's a project gap, which we won't get into now, but I think that's just an interesting thing to kind of throw out into the room, and we can maybe pick that up in a few minutes. But what I kind of want to go into before I throw it out to the audience, so please do have some thoughts and even your perspective on this topic as well. But I wanted to delve, there's some research that you've been doing, and we touched on it at the beginning of this conversation before we kind of the couching in the climate, was around the how do we measure future, like, are we looking, is GDP the correct measurement? And if you could give us a little bit of color onto the work that you've been doing around the expanded GDP and how we should actually be looking at the world slightly differently and looking at the productivity and also future potential of countries in a different way.
All right, so I got into this with Chuck Colton, who is a very fine economist who's also emeritus at the University of Maryland. And Chuck and I have been friends for a long time. And what we started thinking about is how does Google affect utility? How does Google make people better off? And how does the internet make people off to have information so ubiquitously available? So information in general is a kind of natural externality. It's hard to keep information, keep a lid on a lot of information. And it's not, don't price information by the bit. So in general, a lot of it travels around for free. And so what we started thinking about is an old theory from the 60s about how people actually consume. And the idea is that actually we don't consume the way personal consumption expenditures thinks we do, in the sense that we don't actually, when we buy a can of soup, don't, at that point of purchase, we're not actually consuming it. Right? We have to take it home to our kitchens and have a meal. So in consumption, there are all these decisions that have to be made in addition to the transaction that you observe. And so this is naturally going to be affected by widely available information. The fact that, before I buy anything, Google 5 reviews of it makes a difference as to the quality of the purchases. And if I go to a foreign country, being able to figure out where to go, where to make reservations, and so forth is much easier, and I do a much better job of it than I did 30 years ago when I was relying on an old copy of photos. And what we're expanded GDP tries to look at how things impact, externalities impact our consumption. The natural part of that is, of course, negatively impact our consumption, right? So the floods and wildfires that California has been experiencing really affect the quality of life in California.
A follow-up question from that, but please do. Does anybody have anything they want to pick up on? Anything that, please. Thank you.
Can you talk about whether these expanded GDP also looks at the investment impact of what goes on, or you've spent a lot of time talking about the consumption side, but it seems obviously that these investments in software or so on and forth, we've included them now in the accounts, but there still seem to be questions about whether we are capturing them accurately or more comprehensively.
Okay, so I have working paper that goes back to 2020 that talks about, among other things, how we mismeasure intangible investments in property investments. And a key question there is, how do you deflate intangibles? Right? So we have companies like Apple and Google who do nothing but create intangibles. And these intangibles actually have create amazing rates of change. So, for example, Google AI came up with an algorithm called Transformer. And Transformer is at the heart of what has made artificial intelligence really accelerate over the last 4 years. And Microsoft came up with a add-on called LoRa, which has caused incredible changes we've experienced in artificial intelligence over the last 4 months. So, make a long story short, OpenAI spent $1 billion roughly to create ChatGPT. Meta created an also-ran that was attempting to do sort of the same thing for $10 million. But it was definitely an also-ran, not even in the same league. You spend $990 million more money, you expect to get something. But Meta realized that they were hopelessly behind, and they released this to open source. And with those two tools, Transformer and LoRa, hackers basically got meta model to be nearly as good within a few points in terms of consumer metrics as ChatGPT. So here we have something that's going in price from what looks like $1 billion to $10 million to several $100 or $1,000 in the course of months. And most of that actually happened in the first 2. That's an amazing rate of technical progress. How do we put that into GDP?
So yeah, I think the challenge the challenge there is exactly that open source intersectionality of that. I think is really difficult, and networking effect that isn't currently plugged into how we're looking at GDP.
And so, and I have a paper. My paper argues that it's very easy to believe that there's been an acceleration of the measurement of inflation of roughly 1% as we've gone into the 21st. Think about that in terms of we're at 4%. Maybe we're really at 3%. But we don't know because, these problems are terribly difficult. But it's not hard to believe that we're off by.
Thank you. I think that's very interesting. We've got 2 questions and 5 minutes. So, Kartik, can I please take yours first, and then George?
Very quickly, are things like our ability to measure time use improving in a way that can help us think about what all this activity that's happening, for example, in open source world that may not be market transacted, but people tinkering? I'm just wondering how to get the measurements that you might.
People are working at this in many directions. The time use surveys, surveys of how people use their time, and in some cases, add to those surveys how people are feeling during those activities. And those can help us get at how much we enjoy the remarkable recent papers has been about how much young men enjoy playing computer games, how really impacted their enjoyment of life.
Thank you. George?
Yes, my question is whether the NOAA figure of $100 billion a year in losses might not be understated given second and third order effects. A very large insurance company just announced that it would not insure new homes in California. A number of insurance companies in Florida went bankrupt, and of course there's been massive out-migration from Puerto Rico. So it would appear that certain areas of the country are becoming habitable. I'm wondering whether you, taking into account wealth losses, is.
You're exactly right. In fact, most of the losses that we're able to track are capital losses. And in a paper I've written with Brian Sliker, we try to argue that these losses should be deducted from an add-on to depreciation and deducted net domestic product. By the way, if anybody wants any of these papers, website, or they can write me directly. But you're absolutely right that don't include even these numbers don't include the deaths and the morbidity, loss of pollution and stuff like that, and nor do they include most loss of business or at least one event. Those add-ons quadruple cost that we. But the good thing about this data is that it's very, very precise, very useful because it's very strong data. Measuring these other effects is much harder.
Thank you. I'm going to take one more question. Apologies, David. We might eat 2 minutes into it. Okay, we've got a lot of questions, so we'll just do quickly the 3 questions, and then we'll run over by 5 minutes, but we will get that back in the break. So I think that we should go. So Josh, and then yeah.
Is there any thought that, given what George's question was alluding to, that presents a risk to financial stability given the asset size of the insurance industry and the uneven state-based regulation regime of the insurance industry?
Well, I know that the reinsurers are struggling. So, me, a little bit of an alarm bell.
My question is more of a general type. What role do you see for central banks in this climate change fight? Secondly, how do you suggest doing it, changing their mandate? You know, recently Jay Powell said we are not a climate change central bank. This is in stark contrast to Bank of England, which actually likes to take on that role.
Okay, so here again, this is my opinion, but my view is that the Fed, the U.S. Federal Reserve is too powerful already. It has too many things on its plate, and that for it to take on a politically charged role like climate change would be, doesn't make any sense.
One of the things that ONFIF is working on is we survey central banks on their reserve management portfolios and intentions, and we are releasing that in a few weeks, so towards the end of June, and that has some interesting data on where on the portfolios of central banks. So rather than looking at the monetary policy side, it's actually looking about the reserve management and the portfolios that central banks are managing, and that will be interesting. I'm not going to give away too much because there is a launch in 3 weeks, so please do join that to hear that we survey around 75 central banks. They have answered them, we collate, we write analysis on it, and we put that out as an independent way of thinking about what central banks reserve managers are doing, and some of that is around the climate agenda, and I think that's an interesting space for rather it taking on as a central bank mandate, and the Bank of England obviously does stress testing. So again, it's not within so it's looking at also how central banks are thinking about the climate risk rather than having to be explicitly part of their mandate. Isabella.
Yeah, I had a follow-up question to the previous one. You mentioned the enormous need for investments to tackle climate change. Now, if interest rates are going up to fight inflation, there seems to be a tension between higher costs of investment and the investment needed for climate change. So I was wondering how you see that nexus of the need to invest and the need to fight inflation.
I've been arguing that in separate work that, and a bunch of economists have been saying similar things, that interest rates have overall been too low. The rate of inflation has been too low. And so, now what does that mean? I think that we went through a prolonged period of having negative risk-free rates, and that's very hard to sustain, and it tends to lead to financial crises, in my opinion. And there's some research along those lines, some of it. So, you know, it's a delicate balancing act. Having a financial crisis as a result of leaving interest rates too low is a problem that the Fed should not be so committed to 2% inflation rate, given that 2% is actually, in my view, 1%.
I think this has been really interesting. We've covered a lot of ground. Thank you so much for joining me, and I'll also want to thank everyone for your questions as well on that, what central banks can do. We're now going to be talking about central banks' balance sheets, so we're bringing it back into the traditional thinking around QT, central banks. But as I said, please do look at our Global Public Investor, and that's launched on the 27th of June, and to look at the green bond portfolio intentions of central banks as well. And I want to thank you, Leonard, for joining, and this has been fascinating. And please do look up the reports. I was reading them over the last few days, and they have been fascinating, I can definitely say. So thank you so much.